What if I told you that the fate of entire nations, your savings, your job security, even the price of bread can be decided not by politicians or corporations, but by a few people sitting in a quiet, windowless room, pressing buttons that control the flow of money? Sounds like fiction, right? But it's not. The truth is, central banks quietly shape the global economy in ways most of us will never fully see until it's too late. Today, we're going to unravel the hidden power of central banks, how they came to dominate the financial world, and why their decisions ripple across every corner of our lives. To understand central banks, we need to go back hundreds of years. The very first concept of a central bank was born in Sweden in 1668 with Stockholm's Bank, but the real pioneer was the Bank of England, founded in 1694, created to finance wars and stabilize a fragile national economy. These banks weren't just places to store money, they were instruments of state power, capable of issuing currency, lending to governments, and even influencing commerce. Figures like John Law in France and Alexander Hamilton in the United States experimented with these ideas, often with dramatic consequences. Some failed spectacularly, leading to bank runs and economic collapse. Others succeeded, creating financial stability that allowed nations to grow into global powers. What's fascinating is that the central bank model seems to repeat itself across history. A system designed to stabilize money eventually accumulates immense power, sometimes in ways even its founders never intended. And as we'll see, the story is full of twists. The origins of central banking are inseparable from war, debt, and political ambition. Early governments needed funding for armies, infrastructure, and colonial ventures. Banks like the Bank of England solved this by issuing banknotes backed by trust, not gold, effectively creating money out of confidence. The pattern was simple. Governments borrowed money from banks, gives banks created money, gives money fueled growth, gives banks gained influence over governments. By the 19th century, central banks became gatekeepers of financial stability, intervening to prevent panics, acting as lenders of last resort, and managing national gold reserves. They were now the invisible hands keeping economies from collapsing, but only when they acted wisely. The 20th century saw central banks rise to global prominence. The creation of the Federal Reserve in 1913 in the United States marked a turning point. Unlike private banks, the Fed was given the power to control the nation's money supply, influence interest rates, and respond to crises. Then came the Great Depression of the 1930s. Central banks were criticized for failing to act aggressively. Economists like John Maynard Keynes argued that the central bank's inaction worsened the crises, showing that their decisions or indecisions could literally make or break economies. Post-World War II, the global financial system was restructured at Bretton Woods in 1944, creating the IMF and World Bank. Central banks became not just national stabilizers, but global actors. They coordinated interest rates, stabilized currencies, and managed trade flows. The stage was set for the modern financial world, where a central bank in Washington or Frankfurt could send shockwaves around the globe overnight. But power brings risk. The 1970s saw the breakdown of the Bretton Woods system. When the US dollar was untethered from gold, central banks suddenly had to navigate a new world of floating currencies, inflation shocks, and oil crises. Missteps could undead, caused massive economic turmoil. Fast forward to 2008. Central banks worldwide faced a historic test, the global financial crisis. Lehman Brothers collapsed, stock markets crashed, and the world teetered on the edge of depression. Central banks responded with quantitative easing, slashing interest rates, and injecting trillions of dollars into the system. Some hailed this as genius. Others warned it created a dangerous precedent. This is the paradox of central banking. The very institutions designed to stabilize money can also amplify risk if mistakes are mature, if the system itself is fragile. The fallout of central bank actions is felt in surprising ways. Low interest rates may save banks, but fuel housing bubbles. Quantitative easing can stabilize financial markets, but increase wealth inequality. Emerging economies are often at the mercy of foreign central banks' decisions like India or Brazil, where rate hikes in the US can trigger capital flight and currency collapse. History repeats itself. Central banks rescue markets from short-term crises, but sometimes at the cost of long-term instability. They are balancing acts on a tightrope, where every decision has consequences for millions of people who barely notice until prices spike, jobs vanish, or economies contract. Attempts to reform central banking aren't always successful. After 2008, new regulations like Basel III tried to prevent future banking collapses. Central banks experimented with negative interest rates and modern monetary theory. Yet, crises persist: the COVID-19 pandemic, inflation spikes, and debt crises show that central banks are powerful, but not omnipotent. Some economists warn that we are repeating patterns seen centuries ago. Too much reliance on central banks can mask structural problems, postponing crises rather than preventing them. Today, central banks are bigger than ever. The Federal Reserve manages over $8 trillion. The European Central Bank controls the Eurozone's Cinco Euros trillion. And new players like the People's Bank of China wield influence over global trade. Shocking data: since 2008, global central banks have pumped over $25 trillion into the economy. Inflation, asset bubbles, and debt are soaring worldwide. The pattern repeats. Central banks rescue economies in crisis, but the underlying vulnerabilities grow. Even cryptocurrencies and decentralized finance challenge central banks, raising questions about whether this centuries-old system can survive a digital revolution. So what can we learn from the history and role of central banks? Central banks are powerful, but not omnipotent. Their decisions ripple globally. Crisis response often creates long-term consequences. Stability now can mean instability later. Global coordination matters. Missteps in one country affect the whole world. Central banks are guardians of money, but history shows they are fallible. As we move toward a world of digital currencies, unprecedented debt, and volatile markets, the question remains: can central banks adapt fast enough, or will we face another financial shock that exposes the limits of their power? If you found this journey into the hidden power of central banks eye-opening, hit the like button, subscribe, and ring the bell. And don't just watch, start noticing how central bank decisions affect your life, your savings, and your future. Understanding the system is the first step toward financial awareness.